This week we're going to look at growth versus value with a focus on the outperformance or continued outperformance of growth in the US, and then we'll briefly look at valuations and stages of the business cycle. So first up, we're just looking at the performance of US growth. This is according to the MSCI classification, growth versus value, and we've seen a very strong outperformance of growth since 2007, 2008. If in fact we look at the periods of outperformance, there are the shaded, so the series is growth ratio relative to value for the US. And you can see those there. So if we now look at that in terms of an event, which is showing here. So there's been three big phases. October 88 for about 33 months, outperformance of around about 40%. There was also a period from mid-1993 where the outperformance at the gold line was around about 90%. And then the most recent period with a few sort of stops and starts along the way since the mid part of 2007 and an outperformance of growth of around about 65%. That's the black line there. So growth has been outperforming for quite some time. So what are some of the factors that we should be looking at that in terms of factors behind the ongoing outperformance? Well, one of the first areas that we would look at is let's just go over here. Let's just get rid of that and put in GDP growth rates. So what we find in those three phases, certainly in two of the phases, growth has been quite strong. In the mid-1990s, growth averaged somewhere around about 3.5%. And during the most recent phase, after the recovery coming out of the GFC, growth has averaged around about 2%. So, a bit mixed. What about from the point of view of a phase of the business cycle? So growth has managed to outperform in both downturn, in an early recovery, probably arguably late cycle in the late 90s, and during the downturn and during the early recovery. So it really hasn't mattered what stage of the cycle it's been as well. So what might have been one of the key factors is if we look at the implied discount rate for the US, and what we find is the outperformance, once again, the shaded periods, has on certainly two of the occasions been associated with a very big decline in the implied discount rate. So in the mid-90s, the implied discount rate fell from about 10.5 or 11% down to about 8%. Let's just get that more correct. So yes, so it fell from, as I said, 10.5% to about 8% in the mid to late 90s, and then from the peak of around about 9.5, 10% in say 2008, 2009, down to about 8%. So a declining discount rate, implied discount rate in equity markets has been a key factor. Now, that may or may not have been associated with declining bond yields. So let's just look at what happened to bond yields in those periods. And we do see that bond yields have been declining during those periods as well, not in a straight line, but certainly in the late 90s, declining bond yields was associated with outperformance of growth, bonds falling from 9 to about 7. An initial sell-off, but then a decline from levels around about 8.5% down to about 6%. And then, of course, the most recent rally from the GFC onwards, where bonds fell from about 5. So, lower bond yields, lower discount rates, and reasonable growth have been factors associated with outperformance of growth. And in fact, they're probably factors that we continue to see going forward. Turning our attention now to valuations of the equity market and phases of the business cycle. So, been a lot of discussion around about the US moving into a late cycle stage of the business cycle after having been in early recovery. In this chart, all we're doing is looking at the range of valuations according to a Shiller PE approach at different phases. So the early recovery is the blue. You can see there the range of PE outcomes. The average has been around about 21, and the range most commonly, so anywhere between 12 and 23. So that's that one. Late cycle, the range has been wider. You can see quite extreme outcomes. Where we sit at the moment, we're probably sitting at around about 30 or thereabouts. slightly above the typical for a late cycle, but nevertheless what it does show is that late cycle valuations can be quite extreme, quite low, a big range, generally higher. Early downturn, so that's the initial downturn, PEs tend to be in a lower range, and then as one might expect in the sort of later stages of a downturn, PEs tend to be in the lower range. So none of that is particularly surprising. As we move into late cycle, valuations can stay relatively high. What we thought we might also have a look at finally is just profit share and business cycle phases. Once again, the same, we're looking at early recovery. Profit share, this is according to the national accounts, have generally been quite high. As you can see here, the range, typically 8.5 to say almost 12. The range has been somewhat higher in late cycle, and that presumably is the phase of the cycle that we're moving into. The average has been closer to 11. And then as we move through the cycle, early downturn and into the more severe or later stages of a downturn where profit share has declined even further. Thank you.